Gaurav, you're involved in capital raising in Africa.
That's right.
Last decade or so, there's been a lot of optimism in Africa, so it's been relatively easier to raise capital.
I think that there's still actually quite a few challenges out there. A lot of guys come in with the mentality of doing it the way that it's done maybe in South Africa or it's done in Europe or North America. And I feel like that's probably not the right approach when it comes to raising money on the continent.
What are the specific nuances to raising capital in Africa?
There's often a gap between the risk on the ground and the perception that investors need to become very comfortable with the risk on the ground. And one way that we deal with this practically is we actually, or it's almost a form of arbitrage, is we actually often insure the investment. So we put political risk indemnity cover in, and the investors are willing to lower the rate of return they're asking for, and really the insurance costs less than that. And that's one way that we actually address this difference in risk perception.
And who are you finding are the traditional investors and funders on the continent?
So you have the traditional role players, and it's a lot of how our competitors are doing it is they've got the DFIs, and they've got investor networks from outside of the countries where the projects are or where the companies are. But what we find is that there's actually often a surplus of funds in country. There's usually legislation that keeps pension fund and insurance money in country. And we like to attack this money, really, and get local money invested in the projects. And it has numerous benefits. The one being that local funds, local investors understand the investments better, they understand the environment. It's often an easier sell. For them, it really suits their portfolio because they usually have local liabilities. So to get local investments really works for them. And they don't charge for sovereign risk and other things that international investors do. And where you then get an international investor co-investing, they have the peace of mind that someone that's on the ground and that has the on-the-ground knowledge is willing to put in money. So there's that aspect, and there's a second aspect where it almost acts as a political hedge for international investors, in that if there's a political event that's going to happen that would prejudice the project or the company, you have local role players that would exert pressure to try and stop that from happening, that are co-invested with you.
What has created the capital overhang that you speak about in many local countries?
So a lot of regulators or governments, their policy has been to regulate and keep pension funds and insurance companies. They have to keep a certain proportion of their funds in country. And there often is a shortage of projects in country, sometimes artificially created, which I'll get to. So they are keeping a lot of money in cash often to comply with these regulations. Now, when I talk about an artificial shortage of projects, is that typically when the projects are funded, the typical banking model is that the advisors come in country, and they're usually from out of the country, come in country, and they have a network of investors that they are used to tapping. And so it's obviously less work for them to use those investors, and those investors trust them. And so all the money comes from overseas. So you have extra money sitting in country, which is earning a low rate, and then the funds coming from overseas to fund the projects.
We've seen oil prices going down. The commodity boom that we experienced the last decade is slowing down quite a bit. What has that meant for projects as well as capital raising on the continent?
Where the traditional model has been, or almost exploit resources, and the projects have been very much to set up extraction of resources and export. More and more, and it's also the factors you talk about, but also local pressure has been to add value to product locally. And really, those projects are the ones that are becoming more and more viable. And to take an example of a project that we recently worked on, it was a project where a timber project, and the government intervened from the previous owners, from them just cutting down the timber and sending it across the border. And really, I mean, now the model is add value in country.
What other new sectors are we seeing come on board from a capital raising perspective?
Still, the extraction is still very big, and the beneficiation. The service sector is still quite underdeveloped compared to other economies, and so we don't see many projects there. We also see projects in the financial sector. The financial sector is quite well developed, and sometimes you almost see where the financial sector is doing things that it's not done in other places in the world, almost to compensate for other issues or challenges in country.
What would you say are some of the risks or challenges that one should be aware of when raising capital on the continent?
The main risks and challenges is actually what I call asymmetric knowledge, and about almost making assumptions about how things should work or do work, and the reality being quite different on the ground. And so what I think is that people should actually try and find local partners in country to work with. We've often seen projects that have seemed to be heading full steam in one direction, and then all of a sudden it coming to a stop or coming to a roadblock. And so really that could have been mitigated if there was local knowledge and speaking to local parties where people in the know would have said quite openly that no, this project isn't going anywhere or there's major risks for this project.
Gaurav, thank you so much for your time and for your insights.
Thank you very much, Kasi.